Thanks for tuning in to Headbooks. In today's summary, we'll explore the key takeaways from The Intelligent Investor by Benjamin Graham. Let's jump right in. The Intelligent Investor by Benjamin Graham is a foundational guide to smart investing, known for its emphasis on value investing and risk management. Graham begins by drawing a sharp distinction between investing and speculation. He defines an investment as something that, after thorough analysis, ensures the safety of principal and offers an adequate return. Anything else, he says, is speculation. In the introduction, Graham explains the book's purpose, which is to offer guidance on how to adopt a sound investment policy. He points out that the stock market is a fluctuating entity, prone to both exuberant rises and devastating declines, and that an intelligent investor must be prepared for both. Graham stresses the importance of having a strategy that accounts for market volatility and emotional discipline, which he believes are the keys to avoiding costly mistakes. In Chapter 1, Graham introduces the core idea that distinguishes investing from speculation. He explains that speculation is a risky and emotional process, while investment is about patience and careful analysis. He warns against speculative behavior, which often leads to unpredictable losses, and encourages readers to develop a disciplined investment philosophy. In Chapter 4, he introduces two types of investors: the defensive investor and the enterprising investor. The defensive investor aims for safety and freedom from the need for constant attention, focusing on long-term security and steady returns. This type of investor is best suited to a portfolio made up of high-grade bonds and blue-chip stocks. On the other hand, the enterprising investor is willing to devote more time and energy to seeking out undervalued stocks and opportunities, often taking on higher risk in exchange for potentially higher rewards. Graham encourages most people to adopt the defensive approach unless they have the necessary expertise and dedication for the enterprising route. The book discusses the concept of inflation in Chapter 2, warning investors about the dangers it poses to purchasing power over time. Graham emphasizes that investors need to consider how inflation erodes returns and should, therefore, have a balanced portfolio that includes both bonds and stocks to hedge against this risk. In Chapter 8, Graham introduces his famous concept of Mr. Market, a metaphor for the stock market's irrationality. He describes Mr. Market as a business partner who offers to buy or sell shares every day, often at wildly fluctuating prices. The intelligent investor, Graham advises, should not be swayed by Mr. Market's moods but instead use the market's volatility to their advantage, buying when prices are irrationally low and selling when they are irrationally high. One of the key takeaways of the book is the idea of the margin of safety, which Graham discusses in Chapter 20. This principle suggests that investors should buy stocks when they are significantly undervalued relative to their intrinsic worth. By doing so, they reduce the risk of permanent loss of capital, because even if things don't go as planned, they have a buffer between the purchase price and the actual value of the asset. Graham insists that the margin of safety is the central concept of intelligent investing. Another important part of the book is Graham's focus on the psychology of investing. He emphasizes the importance of controlling emotions, such as fear and greed, which can lead to poor decision-making. He believes that an investor's biggest enemy is often themselves, and that managing one's psychological responses to market fluctuations is just as important as understanding financial metrics. In the final chapters, Graham touches on dividend policy in the relationship between shareholders and management. He discusses how dividends can provide a steady source of income and how a good management team should be focused on the long-term prosperity of the company, rather than short-term stock price movements. The Intelligent Investor is a timeless guide that encourages investors to prioritize safety, discipline, and long-term value over the allure of quick profits. Graham's emphasis on the margin of safety, patience, and emotional discipline continues to influence value investors, including Warren Buffett, who has praised the book as one of the best on investing. Thanks for tuning in. Don't forget to like and subscribe for more bite-sized book summaries.